Yeah, thank you, Ben, and welcome everyone to our Alliance Wealth Advisor, what we call AWA Market Minute. We're really excited to be here today and share with you guys some market insights, some economic information. We call it breaking down current events and sharing insights that will impact your retirement. So our host today, we've got Scott Hoxer, our Chief Investment Officer, Mason Page, our Chief Financial Officer, and myself, Paul Coles. And we're all investment advisors, and today we're going to talk to you guys about these incredible topics, and hopefully it's super helpful for you as we kind of gear up for this last part of 2020, which has proven to be quite an interesting year.
That it has.
To say the least.
Very much so.
So let's get started. I've got a story I'd like to share, but before I do, I want to make sure that you guys understand everything we talk about today is intended to be generic and for a broad audience rather than specific. So don't act on this information prior to talking to us specifically, so we can have an opportunity to talk customization and unique situations for you guys. So my wife and I, about 15 years ago, when we first got married, went down to Zion's National Park and we hiked what's known as Angel's Landing. Have you guys been down there before?
Yeah.
I have, yeah.
Yeah, you're a big hiker, Scott. I figured you've been down there. And this is incredible, majestic hike where you see, these rocky cliffs that shoot straight out of the ground, 2,500 feet up into the air. And on this particular hike, Angel's Landing, there's a cliff on both sides of you. In the middle part, the ridge line, at some points are only as wide as 3, 4, and 5 feet wide. And so they'll actually put chains along Angel's Landing where you can hold on to in case you get nervous because the sides are getting too close on both sides. And so my wife and I did this hike, and the thing I remember most about this experience was how comfortable I felt. I did not feel nervous, I didn't feel anxious, I didn't feel concerned that at some point my wife or myself was going to fall off, and she kept looking at me, holding on to these chains, kind of clinging. And at one point, I felt so confident and comfortable, I actually jumped up and did a heel click, kind of clicked my toes. And she said, you're really feeling overly confident on this. So long story short, we finished the hike, everybody was fine and safe. Flash forward 15 years later, my wife and I have 4 children now. We've got a 12-year-old, 10-year-old, 8-year-old, and 5-year-old. And this summer we took them to Bryce Canyon. You guys have been down to Bryce?
Uh-huh.
I have.
Awesome. Okay, so we're down in Bryce Canyon this summer. And we went and did what's called the Canyon Rim Trail. So Bryce is this big horseshoe, and along this horseshoe there's a trail that kind of traces the outline of the canyon, but it's a sheer cliff on the one side, the inside of the canyon, and then it's this big, long, wide trail, like 50 feet wide, and on the other side, it's not a sheer cliff, it's just this gradual slope. So there's virtually no way you're going to get yourself into trouble on this hike. I mean, you couldn't have a hurricane wind blow you off the edge unless you were standing right on the edge, which we weren't doing. I was sweating bullets. I mean, I had my 4 little kids there. My 5-year-old kept wanting to just walk on his own, and I was grabbing him around the neck like in a headlock, and I was like, dude, you're not going anywhere. My 12-year-old found herself, there's a little park bench kind of maybe 10 feet off of the edge, and she said, Dad, I want to go sit on that bench and take a selfie of me on this bench with the background. And I said, no way, you're not going anywhere near that cliff, that edge. Okay? My wife finally turns and looks at me and says, what happened to the guy that hiked Angel's Landing with me 15 years ago? I said, I honestly don't know. I don't know what happened to him, but between the triggering events of what I'm experiencing here today with our kids and whatever the environment's happening, I was in a total state of panic. I was sweating. I had anxiety. I was getting vertigo. I mean, it was just a completely uncomfortable situation for me. And here was my takeaway. My takeaway was this. We can't be defined by our risk tolerance in a moment, because that's a complex and dynamic experience that we have. People tend to be more risk averse when the markets are going down. People tend to be more risk tolerant when the markets are going up. And the idea here is that to define ourselves and label ourselves with something as simple as like a conservative or a moderate or an aggressive label isn't very effective. So as we kind of walk into today's discussion on what's happening today with the economy and the political landscape and all the headlines that we're going to cover today, I want you guys to consider the fact that we haven't had any one of our clients go through and label a simple label of risk. we've gone through and gone through a complex process utilizing an algorithm-driven test to determine a speed limit that our clients can be assigned to, right? So instead of saying you're conservative, you might have been assigned a speed limit of a 49. Instead of saying you're moderate, you might have been assigned a speed limit of an 82, and those wouldn't seem to make sense. Or we've seen people that were previously assigned aggressive, and they had a speed limit of 22. The idea here is this. We know what kind of volatility you guys are comfortable taking on within your portfolio, the movement of what your assets might do given certain triggering events. We know where you can drive that won't trigger within you an irrational reaction. The one that I had while hiking the Canyon Rim Trail was far more irrational than the one I had when I was hiking the Angel's Landing, and the two were very different, and I still triggered more on this one. Okay, so we know what your speed limit is, and we know what kind of volatility you're comfortable with. And if you're driving let's say an 82 miles an hour, we understand the volatility, and you're not likely to be triggered given certain economic conditions, right? And if you're driving closer to like a 30 or 40, whatever that next number might be, we know that you can't withstand a lot of volatility. So our objective is to keep your portfolio in alignment, right? So that you can drive a speed limit. And we say to people, know your speed limit, stay in your lane, and then put the car in cruise control, right? And regardless of what happens, the events that we've endured this year in 2020, the events that we may still endure at the back half of this year, if we're knowing our speed limit and staying in our lane and putting the car in cruise control, we're going to be able to get through this. And everybody on this call today that we've worked with clients of ours, this is what we've done for you. Okay, so we don't want you guys to overreact or panic. If you hear certain headlines that cause you to be nervous, we've already kind of put you guys in cruise control. Okay, that's the objective. We don't want anyone to emotionally try to buy at the top and sell at the bottom, right? This is a cycle that will end up costing you guys a lot of money in retirement. There was this really cool study done from Schwab. You gave this to me a little bit ago. And in this study, they actually showed 3 different kinds of investors. Okay, they call one the stalwart investor, one the reactor investor, and one the waffler investor. Okay, now in this study, each investor saved the same amount of money annually, and they all started at the exact same starting point. Okay, so again, same starting point, same amount of new dollars being invested, and the exact same time frame and the same market movements. So they ended at 3 very different places. What drove their ending points was their behavior during that market movement. Okay, what drove their ending points was how they responded to the market. So let's take a look and examine each of the different behaviors. So the first guy is the waffler. Okay, now the waffler, every time they entered a bear market, the waffler would notice the account value going down and get nervous, and they would want to sell their positions and then wait for the market to appear kind of better again, where the markets, for lack of a better term, started to become well again, and they would buy back in at a point where they felt comfortable. And the waffler would do this over and over and over again, and at the end of 40 years, the waffler ended up with about $615,000 in the portfolio. Okay, the next behavior that we'll examine is the reactor. Now the reactor had maybe a little higher threshold for risk, and they could stomach some of these minor bear markets to the degree they did not move often and regularly. However, the reactor, during the major financial crisis of 2008, sold everything and said, I can't do this anymore. I'm terrified, I'm panicked, I'm nervous. And so the reactor simply sold everything, went to the sidelines, utilizing a bond fund, and ended the portfolio with $485,000. Okay? Now, the final investor is called the stalwart investor. Now, this is the one who knew their speed limit, stayed in their lane, and set cruise control. Okay? In other words, they didn't make a bunch of emotional reactions during market volatility. They simply said, I'm going to know my speed limit, stay in my lane, and set cruise control. Now, in order to do that, they had to truly know their speed limit. So the stalwart investor sat down, took the test, the one that we've administered with you, and they were able to withstand the volatility without making any changes because they weren't driving faster than they were comfortable driving. Their emotional, psychological speed limit was well within the tolerance of what their portfolio was doing. And so the stalwart investor ended the portfolio 40 years later with well over $1.1 million. I mean, that's like nearly double what the waffler did and almost 3 times what the reactor did. Okay? So the takeaway for you guys is we want to make sure that you're comfortable with the speed you're driving, and then we keep you in that lane, right? We keep you right there in that lane. So what we want to do is let's switch gears and talk about headlines from around the world. And these are some current events that we're seeing that we thought maybe you guys would be interested in. And the first one I thought was interesting. We talked about the Chinese trade war 2 years ago, and we talked about the sanctions that President Trump kind of put on the Chinese government of $200 billion in tariffs on the Chinese goods. And it kind of went away, right? We kind of don't talk about that anymore and haven't. And then all of a sudden, just this week, the World Trade Organization actually came out and said that they believe that the president was acting inappropriately and exceeded their ability to slap tariffs on the Chinese government. And so they're accusing the president of violating trade rules right now. Have you guys read this?
Yep. Yeah, super interesting here, Paul. And I read this and have kind of thought through this. Trade in and of itself is a good thing. We've all been trained in classical economics, and the idea is, free trade's a good thing, and it lifts, all boats. But the premise there is that the trade is fair, and that the arbiter of the trade is, a good referee or a good judge. And this feels a little politicized. I mean, it's a couple of years after the fact. You question the motives when it's that far removed from the original event.
Yeah,
it's really something where we look at it and does it take them this long to make a decision on whether they want to come after the United States and President Trump, or is it something where it's kind of been it feels like it's timed out, but who knows exactly where it is. What's comforting is that as we build portfolios and do smart investing and we do institutional portfolio management and we look at different areas, these things can take place all day long because we've planned for it. Same with the risk conversation that you just barely had, Paul. These things are interesting as they happen and so fascinating, and we all wonder the timing of it, but we prepared for it and the possible ramifications in the market.
Yeah, that's a great point, Mason. I appreciate you bringing that up, because the political arena is going to heat up over these next few weeks, and we're seeing that play out right now when we see headlines like the WTO going after President Trump 2 years after the fact, saying he violated trade rules. Does make you think it may have been politicized, and makes you wonder how that will impact market movements. And to your point, Mason, we kind of have a position of an all-weather approach where we really don't care. Of course we care. We want the market to go the right direction, but at the end of the day, when we plan for someone's retirement, this kind of political stuff is going to continue to happen, and our buckets allow for that all-weather approach. So.
One more thought on that, Paul. There's always a crisis either occurring or brewing. I've been doing this a long time, and there's always something on the horizon that's concerning or gives people consternation. It's just the nature of kind of the world we live in and the investing world, and so it's better to kind of have that all-weather approach so you're not being super reactive to headlines.
Yeah, no, that's a great point, Scott.
Yeah. I found this headline. I like this quite a bit. Thought it was fascinating. Warren Buffett made a bet on a company that went public. The company is a technology company. It's called Snowflake. As it went public, Warren Buffett made a bet of $250 million.
Just some small change.
Yeah, not too bad, right?
Little walking around money.
That's right.
Yeah. By the end of the day, that $250 million had turned into $800 million. So not bad. There's plenty of reasons, 800 million reasons why Warren Buffett is the investor that he is today, and obviously billions more.
Yeah, we call him the Oracle of Omaha for a reason.
Yeah. What I think is so fascinating is that these headlines are so cool and so much fun to read about. Well, it's cool to hear other people have success stories like this, but most of us don't have 250 million that we can place a bet on.
Yeah.
And most of us don't have 250,000 that we can place a bet on.
Yeah.
And so as we hear these stories and these flash in the pan type stocks, and as they take off with their offerings, more often than not, we're in a much better position to just diversify, buy good quality companies, and have a balanced overall portfolio rather than trying to do this. But kind of cool for Warren to, not that he needs the money, but cool for his company.
Yeah.
I'll tell you what, though, if I'm the management team at Snows the Ticker, I'm a little bit out of shape, because what happens is the people who take those companies to market, they have to make an estimate as to what the appropriate price is. So all
Some
of the
bank
money
goofed up on that.
Yeah, all of the money that should have ended up in those folks' pocket ended up in Warren Buffett and others' pockets.
The inverse happened with Facebook, where Morgan Stanley took them public, and they screwed that up big time, and there was a lot of money lost to investors.
Yeah.
So and I also think it speaks to, institutional portfolio management, the idea that we have investment selection committees that are out there doing the due diligence on these individual companies to determine the valuation before we ever put them in one of our clients' portfolios.
Yeah.
Right? And having this kind of team of individuals really makes a big difference. So
I've got one. So Deutsche Bank tells U.S. staff they can wait until mid-2021 to return to the office. So working from home has become very ubiquitous with COVID-19, and here's another evidence of this, where a global bank is telling their staff, hey, we're mid-2021 before we're going back to work. And we feel like this isn't something that's going to end with COVID-19. We feel like this is something that's going to be a longer term trend, and there's significant impact there. You think about the impact to commercial real estate.
Yeah.
That's a space that's already hurting, and you're going to have increased vacancies, less demand for office space, and this is kind of an interesting theme. I mean, I'm interested in kind of your take on this development we've seen with COVID.
Yeah. I don't know. Go ahead.
I was just going to say the economic fallout is going to be huge all the way around. As we look at it, real estate's going to suffer, commercial real estate, and then we just look at all of the modes of transportation that people normally take, and then the different stops that people make along the way, just getting to the office. Stop for gas, and you might go in and get a drink, or whatever it might be, and so I think that there will be quite a domino effect.
Yeah, I think economic impact on this kind of thing, is going to have a domino effect. In fact, one of the articles that, the headlines that I'm looking at specifically talks to that economic impact and the domino effect of it. Right now, we're seeing, kind of in connection to this, holiday sales and retail stores who rely on holiday sales concerned for what COVID is going to do. In fact, they estimate that holiday spending accounts for 20% of U.S. retail spending. So when we step into this COVID environment, things like Black Friday, stores are already announcing they're shutting this down.
Yeah.
Right. So talk about the economic impact of sky rises, going vacant, and the economic impact now of what Halloween will do. So it's interesting. So Hershey is working with public health experts, saying that they want to try to come up with websites where people can see where the coronavirus hotspots are and avoid those neighborhoods. And they're asking lawmakers to kind of come up with better guidance for maybe even like drive-through trick-or-treating or TV parades. So like the Macy's parade, they announced that it's going to be a TV-only parade, and they're going to have the big vehicles carry those balloons around. We've got clients who have gone to this parade every year and been, the people that have carried these balloons around, and it's been this incredible tradition, and we're seeing traditions changing now, right? I mean, they're not going to have the ability to do that. They're going to have cars carrying this. We're going to watch it on TV.
Yeah, remarkable. Just the changes across society. We tend to look from an economic angle, but there's the very personal angle as well, where you think about as a kid going out trick-or-treating and the rite of passage that was, and how that's kind of been upset, and then there's the economic impact. You think about the impact to holidays and holiday parties and those who provide goods and services for those types of things. It's a significant change that we're seeing, both economically and socially.
Yeah, I think one of the things that is interesting on the flip side is that we have made a lot of advances in technology. Obviously, that's not new news, but there's been a lot of advances that have made it so that Hershey's can get together and try and pinpoint the best way to do some of these things and some of these activities so they can still go on, and that we can still, to a degree, be with family and do some of those other things that we do.
Yeah.
One of the things that was more of an opportunistic thing with this whole COVID-19 is There's been Apple just released their products for this year and some of the changes and updates that they've made. And one of the big changes was with the Apple Watch. They added a blood oxygen sensor to the Apple Watch, which I thought was pretty fascinating. There's been, as we've seen COVID-19 take place and everybody's had to change what they've done, a lot of the professional sports leagues have had to adapt to what they're doing.
Yep.
And a big thing is they've been giving their players or employees, staff, different fitness bands to try and help. And one of the detectors or things that's detected COVID-19 for positive tests has been blood oxygen levels from these sensors.
That's cool.
So now Apple's made it public for everybody, and other people are being able to take advantage of it in their own personal lives. So there's been some opportunities created from COVID-19. Obviously, we've seen the economic fallout and personal fallout, but opportunities as well that companies have taken advantage of.
Yeah.
And that's one thing that's really impressive me. And it speaks to how dynamic our economy is and how quick on the fly people can make these adjustments. I mean, think about from the time, the lockdown started to occur till the time businesses were making significant changes and accommodations. That was a pretty short time frame.
Yeah.
They accommodated on the fly. We've had to accommodate on the fly. And I think it speaks to, the American economic model and how resilient and how robust it is and how quickly we can change on the fly. It's not a Titanic that can't turn very quickly. It's pretty nimble for how large of an economic presence it is.
Yeah, I think that's right. It's interesting to see how the economy as a whole is evolving around the circumstances that we're in right now.
Yeah. I have another one here that I thought was interesting. This is from the Wall Street Journal. Is the Fed seeing shadows, or should we really be worried? Pretty ominous, right? And what precipitated this? The Federal Reserve recently met, as you guys know, and they gave some guidance for the foreseeable future as far as where they see interest rates going. And there was an indication that through 2023, they anticipate the rates will be unchanged.
I read this.
2023. That's 3 years in investment terms is a long time.
It's an eternity.
And this article speaks to the fact of they're making this declaration, but is it genuine? Do they feel that in their heart of hearts, or are they perhaps trying to maybe indicate to the market that they are going to have rates low in an effort to kind of stimulate things? What do you guys think? What was your take as you read this?
Yeah, I mean, we talk about inflation all the time with our clients and the impacts of inflation and whether or not the Fed and Jerome Powell are serious about keeping these rates where they're at for 3 more years. I think to your point, Scott, it's likely that what we're seeing is good news, and good news generally helps the market. And it's also possible that they really have done the appropriate analysis and they're saying, no, we believe we have 3 years before inflation is going to be a problem, and so we're going to keep rates where they're at. I think what it speaks to for me, more than anything, is the idea that how we own investments for our clients is kind of prepared for this, right? In other words, if we see an inflationary cycle hit and our clients' money is not allocated in mutual fund fixed income positions, right? We're not going to experience market value adjusting in our portfolios. So we own, our clients are largely allocated utilizing individually held bonds, which will not market value adjust in that kind of an environment. And likewise, if we do own any kind of an ETF, it's going to be a tactical model where they're kind of bouncing in and out based on this kind of information. So that kind of gives me some solace and peace of mind as I see these headlines. Regardless of which direction this is, if the Fed's showing their hand or they're serious, our clients' fixed income positions are going to be kind of prepared for that movement.
Yeah, in addition to that, they've got lots of levers that they can pull as far as at the Fed. And we know they've got lots of ammunition for whatever our economy might need. And so as things go along, obviously 3 years is a pretty hefty projection, or big projection that they're looking at. And so it'll be fascinating to see where things go with rates, just because there's a lot of different levers that they can pull to try and help our economy, whatever might be that we need.
Yeah, well, that's kind of a spin around the block on what we've seen recently in the headlines. And I think let's take a minute, Scott, and let's do a little economic outlook from our Chief Investment Officer.
Yeah, no, I think the discussion around the Federal Reserve is a good transition into a little bit of economic analysis. So, one question that we've had over and over again from our clients is, why is the market up as much as it is? If you think about what's happened over the last 6 months, where you have a pandemic, a contentious election, a social unrest, natural disasters. I mean, you name it, in 2020, it's happened. I think, most people are a little excited for the calendar to turn and for things
Something magical is going to happen on January 1st.
That's
We can
right.
all feel it.
That's right.
We're ready.
That's right. But, genuinely, they've looked at it and said, hey, the market has recovered significantly. NASDAQ's up more than 60% relative to the low. Why is that so? And there's a couple of things at work here. One is, we know that the market's a leading indicator. The market typically bottoms out well ahead of the economy overall. And on average, as you can see in this slide right here, it's about 5 months. So typically, market bottoms, and then 5 months later, economy bottoms. And there's probably a similar dynamic happening here. The other thing that we're seeing is tons of stimulus coming in from the federal government. There's a lot of cash in the system, and that tends to, inflate assets and increase the value of stocks and other securities.
I think it's an interesting point, that the market is a leading indicator for the economy as a whole. We look at all these, economic indicators that tell us, what we can expect or assume might happen going forward, and the market itself tends to guess when the economy is going to start to improve, and historically we've seen these numbers, 5 to 7 months. So I think that the hope here is that the market has kind of priced in what the economic fallout has been, and if that pans out to be true, then sometime Q4 we'll start to see the economy really pick back up again, and I think that hopefully coincides with maybe a vaccine or just a general sentiment that this is our new normal. It's time to get back to work.
Yeah.
So that'll be interesting to watch.
I think that's right, Paul, and I think the markets right now are pricing in kind of a hockey stick shaped recovery, not a sharp decline and then rapid increase, but kind of a recovery that's long in the tooth. And that's kind of corroborated by the Federal Reserve statement on interest rates as well. Other thing we wanted to call out is we've really seen a tale of kind of two markets. You can see in the slide here we're looking at where the market is up significantly relatively to the lows, but not all stocks are obviously created equally. Things like technology, healthcare, telecom, those comprise about half of the S&P 500, and they've provided the market leadership. You look at the Facebooks, the Googles, the Regeneron, pharmaceuticals, those types of names, those have really, really led the pack, and they've done the heavy lifting for the market. Conversely, things like consumer discretionary, financials, industrials, those kind of brick and mortar type names have really struggled. I have kind of my own thoughts on why that is, but why do you guys feel like we've seen such a tale of two different markets?
Yeah, I attribute a lot of it to what Paul said earlier, or maybe you said Scott. Somebody said it. That our market.
If it was really well said, it was Scott.
Scott, you get the credit here. So our economy has adapted over time, and we've seen it be very resilient as far as the years go. And this year, same thing has happened, and as things have taken place, Salesforce has taken off.
Yep.
The word
Zoom.
Zoom. Yeah, Zoom. Who was on Zoom's radar, or who? Yeah, who was paying attention?
Zoom was on nobody's radar a year ago, and we were barely cracking into that thing.
Yeah, and so these different.
Now we hold church on Zoom.
Yeah, exactly. We're using it in all sorts of ways.
Yeah.
But it's something that now we rely on, and just going back to the working from home and different things like that, there have been new needs that we've had in the market, and a lot of those things have been attributed to what's been taking off. And then, of course, we've seen the obvious things, like with energy being down. That's pretty obvious with the...
People aren't driving cars.
Cars flying.
Supply chain's been disrupted, so we're not seeing as much transportation there. And no, I think that's exactly right. I think that we're seeing, the opportunities still there for Amazon, for example, to be able to sell our goods and services online now. So its stock's taken off, and we're seeing Zoom and Salesforce and all these other technologies. And like you said, Scott, that kind of makes up a big chunk of this, development movement that we've seen in the market. Whereas, some of these other services that are kind of the backbone of Main Street, so Kimberly-Clark and Johnson & Johnson and General Electric, we're not seeing as much movement there. People aren't able to purchase those goods and services like we used to. But I do like the idea that we've kind of positioned our clients in a diversified portfolio. So their value positions, we're not telling people to get out of value. To the contrary, we're continuing to maintain those value positions because we're confident that a well-diversified portfolio, as the economy continues to kind of come out of this COVID era, we are going to see some significant, I believe, movement in those value positions, and that's going to bolster what their performance is going to look like for 2021 and 2022.
Yeah, no question, Paul. There's a lot longer runway and a lot more upside in some of those value names than some of the tech names. We had a pullback in technology recently where the Nasdaq pulled back about 10%. So, and that was probably due.
I think so.
I think
I think it was good to have the volatility re-enter.
Yes. Yeah. Yes, that's
we
right.
We lose our false sense of security to a degree.
Yes.
Right.
Yes.
Yeah. Want to spend a minute on the presidential election. I know it's front and center everywhere, and we don't want to be another forum to kind of beat a dead horse here because we know that everyone's talking about it. But we do want to look at it from an economic perspective and a market perspective. There's a lot of scenarios that could play out as we look at the chart here. The presidential race is tightening. We've seen that over the recent months, and right now, it's about a 6 percentage point difference between Biden and Trump, with Biden in the lead. That is compressing, and it's feeling increasingly like it's going to be a coin flip. It's going to be a tight race. But we look at it from the perspective of what are the different contingencies, what can play out, and how's the market going to respond. I will say this, historically, as cynical as it sounds, markets have performed best in gridlock scenarios.
Yep.
So when there's divided Congress and an executive branch, that's typically when markets do their best. But we can point to evidence where the occupant of the White House isn't the primary determiner of how the market does. So as you guys kind of prognosticate, what do you guys feel like a change of the guard in the White House would do to the market and do to specific industries?
Yeah, my hope would be if we do see a changing of the guard, that and this kind of contradicts what you said, and I believe historically you're correct. My hope would be if we do see that we're not going to see a major market pullback due to the deregulation or the regulation concerns or the potentially worse tax liability it might look like for these big corporations, but rather maybe hopefully we see a little more political, a little less political dysfunction. Right now we have a pretty ridiculous political dysfunction. So if we do see a changing of the guard, my hope would be that with less political dysfunction, that things are a smooth transition. It's really anybody's guess whether or not that works or not. But that would be my hope.
Yeah. It's so interesting talking about the politics of all of this, just everything that could take place with our economy and where the market could go and whatnot. I think when it comes down to it, and when we talk about institutional portfolio management, these companies and stocks that our clients have is based on earnings growth.
Yeah.
And if these companies, they've got one thing in mind. Microsoft still wants to make money.
Profit.
Yeah. And they don't care who's in the White House, who's what party's in there or anything like that. Obviously, regulations and taxes and things can affect earnings, but their whole goal is to keep growing.
Yep.
And whatever it might be, moving things along in the respective areas.
And that's an interesting point, because if we go back and track the growth of these stocks over the last almost 70 years, it really does track earnings, right? That's what we're driving the market off of, rather than speculative saying, well, it's based on the zero-sum game. It's really based on earnings, and you can track those numbers. And so, profitability, and at the end of the day, these companies can choose political sides, but I think it's really disingenuous. I think they're trying to drive earnings, and so we're trying to be very intentional about what we own in our portfolios for that purpose.
Yeah. No, I don't disagree with any of that. I do think if we reduce things to kind of value and growth, I'm of the opinion that should President Trump be reelected, some of those value names will rally. I feel like the Exxon Mobil's, the banks, those types of companies that would benefit from a lighter regulatory touch. We would see some upside in those securities. So keep an eye on that. We feel like if that doesn't change, value is going to be something that's going to have a nice run. Conversely, we feel like tech will probably fare well in either scenario. right? If there's a change of the guard there, and there's increased, mandates for, clean energy and other things, some of these technology names, some small company names, those are the incubators for new ideas. Those might tend to do well. So, interesting fall.
It is,
to say the least.
Yeah, it will be.
Next thing we want to talk about is some of the economic data that we're seeing. We won't spend a ton of time on this, but some interesting data here. So, slide we're looking at here is the growth in the debt. So, COVID-19 obviously resulted in the lockdowns, and those lockdowns, led to economic trouble, and the government stepped in and put a lot of stimulus in place to the tune of $3+ trillion. As a result of that, the federal debt load has exploded. We're at 110% of GDP. We're at post-World War II levels, the levels immediately following World War II. And this is a significant debt load. There's no two ways about it. This precludes the United States from being able to do other things that they otherwise might like to do. Infrastructure, for example, is potentially impacted by this. Additional COVID stimulus, is something that's a contentious piece right now. But these are significant debt loads, and they preclude us from doing a lot of things that we otherwise would be able to do. As a corollary to that, the supply of money has increased. That supply has increased markedly, and the combination of a significant debt load, significant increase of the money supply, historically, as we look over the annals of history and in different economies, that tends to be very inflationary. And we feel like with inflation, it's not an if, but a when. And so the concerning piece for us, and by extension our clients, is how do we manage for inflation? I have some thoughts there, but I'm interested in your perspective on what are some good hedges against inflation? What can we and our clients do to make sure that we adequately hedge against inflation, against this storm that is coming? We don't know if it's next year or the year following, but there's enough of a tailwind here where inflation feels likely.
Yeah, I totally agree with that. I think I always tell people there's three things that you need to do to prepare for these inflationary moments, and the first is check your savings accounts to ensure that you don't have a surplus or an excess of money there. When inflation hits, you won't feel that your money's at risk when it stays in a savings account, because you'll see the balance stay the same, but what you're not paying attention to is the purchasing power of those dollars is being cut down significantly. So it feels like, well, I've got the $400,000 still there, but you can't buy $400,000 worth of goods and services as the years pile on. So that's the first thing. The second thing that I always tell people to do is try to buy and utilize investment vehicles that are good hedges against inflation. Real estate, stocks, equities, those types of vehicles tend to do really, really well in inflationary environments. They are driven up during inflationary environments to keep up with that inflation. So the third thing that I tell people is try to be careful utilizing or cautiously utilizing instruments that are penalized during inflationary environments. For example, mutual funds that are fixed income type mutual funds. When interest rates go up, they go down in value. It's called market value adjusting. You guys know this, but they go down in value, and so people that think, well, I'm avoiding the market volatility by buying these mutual funds with fixed income holdings, they're actually kind of going from the frying pan into the fire, so to speak. And so our goal there is to review what you own and ensure you're not going to be exposed in this inflationary environment.
I agree with both of you wholeheartedly on all of those thoughts, and this is one of the many reasons why we believe so strongly in institutional portfolio management.
Amen.
We've talked about it today. We've talked about it in the office with all of you. But institutional portfolio management is keeping it simple, buying good quality assets that you can hold on to for a long period of time, and that we can use as a hedge against inflation. And all at the same time, we're going to make sure that it's within your risk comfort zone or risk tolerance that you're comfortable with, and make sure that it's doing its job in the long term on all fronts of your financial plan.
Yeah, that's a good point. I think that's kind of the whole concept that we talked about at the beginning, that speed limit, right? Knowing our speed limit, staying in our lane, and setting cruise control.
Yeah, I love the point, Paul, you brought up about bonds, and I think because of the long bond bull market that we've had. I mean, we've had 20 years of a bond bull market where people in their minds think bonds and safe. Those two terms have become synonymous, and that's not the case. With bonds, one has something called credit risk, where if the issuer defaults, you potentially lose some of your investment there. And the other one is interest rate risk. And the cool thing about bonds is they're formulaic. We can say, hey, if a rate goes down by X, how much does the bond decline by? And if we have a 3% increase in interest rates, a 30-year bond can go down by as much as close to a third in value.
That's right.
So that's something to keep an eye on, and something that we help people navigate, because there's a lot of misinformation out there. A lot of people think, hey, if I put funds in a bond fund, I'm golden, and that's going to be my protection, and that may or may not be the case.
Yeah, that's a great point. Well, I hope you guys enjoyed kind of hearing us go through the headlines today, and our understanding of the economic landscape, the political landscape. I think the takeaway that we want you guys to leave with today is there's a lot of information out there. I often jokingly tell people we're not in a pandemic, we're in an infodemic, and just know that your team here at Alliance Wealth Advisors is paying attention to all the details. We are cutting through the information to find out what's most important and relevant regarding your investments and your retirement plans, right? So we are not asleep at the wheel. We're very much engaged in this process on a daily basis. You have a whole team here at Alliance Wealth Advisors that is ensuring that your retirement is being babysat and watched over and taken care of. And as we enter into some of these inflationary cycles, or a particularly contentious political arena that we're walking towards here, just know that we are watching these details on your behalf, and through institutional portfolio management, through smart investing, that dynamic distribution model that we have built for you with the different buckets of money, and through our comprehensive financial life partnership, we're confident that you guys can enjoy a very comfortable and peaceful retirement, because you deserve that. The last thing that you want to be doing right now is stressing over what might come. There will always be another crisis. There will always come another crisis, and your jobs is to enjoy retirement. Let us worry about how to position things to protect you from those forthcoming crises. So on behalf of our team here at Alliance Wealth Advisors, we want to let you know how much we appreciate you. We appreciate the relationship. We love what we do. We tend to geek out a little bit on the financial news, but more importantly than what we do, we love who we do it for, and that's you, our clients. So we appreciate you, and we'll, with that, sign off. Thank you, everybody.